Welcome to Sunday Night Charts. It's make it or break it for the S&P 500. Let's get right into it. Let's start out with the breadth indicators and look at the percentage of S&P 500 stocks above their 50-day moving average falling to 33%. Definitely correction territory. Definitely an area where we would expect a bounce and look for traders to believe that coming into the futures open here tonight on Sunday that the market is oversold and will be looking to gap up or at least move higher off of its bottom from Friday. And look, every time it gets down here on the 1 year chart, you see these -2 standard deviation or somewhere in that zone. What do you see? Bottoms in the S&P 500. So what I expect is traders to have been buying this on Friday, knowing that they're thinking this is oversold, looking for a bounce coming out of the futures open. Let's look at the percentage of stocks above their 200-day moving average. This is down to 53%, and not exactly in the danger zone, starting to get really close. And you can see when it falls between this -1 and -2 standard deviation, you start to get bounces. Now, whether it's a short-term bounce like we see come back here going into October, or more of a bottom and then moving out of that, looking at December, you see a nice bottom, and clearly traders again are going to be looking at this saying the market is indeed oversold. There's been too many sellers, and we got evidence of that too. But hang on a minute, because one thing I like to look at is the historical range, looking at the percentage of S&P 500 stocks above their 200-day moving average going back to the early or the late 80s, and we can look and see when it gets to this 50% level. Remember, it's at 53%. So when it gets down just below this 50% level, where you see this red line at -1 standard deviation going back, what do you see? You start to see a bounce usually starting to occur there. Now, not all the time. Sometimes it drops down a little bit deeper, but the odds are in favor that there is a bounce or potential short-term bottom coming here. Now, if it fails to hold at a level there and more of the S&P 500 starts to sell off, well, then you have a severe correction. Then you have something to look and perhaps be a buyer if you've been on the sidelines. Let's look at the advanced declining. So here we see the S&P 500 stocks advancing minus declining at -60%. So definitely you see selling pressure, stocks going down, and that again is indicative of a bottom, a near-term bottom. And you can see when it gets in these deep levels, the probabilities that there is a bottom, even if it's a short-term one, are high. So again, everything's telling you that we should see a sort of relief rally, if nothing else. And if it doesn't, boy, that means really bad news for the broad market. Let's take a look here at the relative strength indicator. It's a popular technical tool, and even it's telling you the same thing going back a year, that, hey, the S&P 500 is massively oversold, and that, again, is a big signal. So all you're seeing so far is signals for traders saying, buy this dip. Now, I'm not suggesting you do that, but I'm just telling you what traders are going to be looking at this. Now, if you like a little slower pace, maybe you like a moving average crossover. So we'll take a look at the MACD, and the MACD is not saying to buy yet. It's saying, hey, there could be a bottom here, because when the MACD, even on the 1 year, gets this low, well, that does tend to be bottoming around than before. So if you like a bit of a lagged move into the market, well, you can wait till the MACD crosses over and gives you your signal and hang tight, because, well, it's not quite there yet. Well, let's take a look at the momentum signals. What do we have? The 21-day, 50-day, and 100-day moving averages all turned and headed lower now, flipping bearish. Momentum is bearish to the downside. The S&P 500 is below all the key moving averages, and 1 month momentum now is negative. But you'll notice the 3, 6, 9, 12 month are still positive. Well, the 3 and the 6 we'll just say are barely positive, maybe not for much longer, but it's still showing you that the S&P is in a rising trend. It hasn't broken down, giving you an indication this is perhaps nothing more than just a correction. And of course, those technical indicators are telling you that. Let's take a look at the chart. We've got the volume profile line turned on. And what happened? We went from a sell zone, and we identified this in the show. If you've been a regular watcher, you know that this is up here is a sell zone, and what's down here is a buy zone. And prices came down right into this chunk of volume here, where there had been buyers once and twice before. Those buyers capitulated and now have fallen down into this supply zone, where again we should be looking to see it firm up. And if it doesn't, it may dip a little bit lower. Let's go out to the 1 year chart, because you can see there's this chunk of volume here, and then a little bit bit less, and then you get into another little chunk, and that other little chunk is right in here where perhaps we saw buyers before, and perhaps we'll see them again. So potentially some more downside for the S&P, but again, based on those technical indicators, traders are going to be coming in and buying this. If they can't or don't, or maybe there's some mechanical selling from a computerized algorithms to drive the market lower, you've got a ton of support right below there at 416 on SPY. So right now we're in a supply zone where buyers have been at, suggesting based on all the technical signals that buyers should return here. If they don't, well, your next floor down is 416. It'll probably come into first 430, 431. Try to hold there before it breaks down to 416. Now what I want to do next is take a look at junk bonds, and of course we also want to see what Momentum Timer Pro's been up to, because if you're not on this list, it's still free. We're not paid yet, but notice that it picked up 5 consecutive days of sell signal. So if you're a short-term trader, it nabbed that. If you're a longer-term trader, what did it tell you? Well, if you're on a 1-month scale, still saying hold a minimum position. 3-month or 6-month, you can still hold a mid-sized position. And why might that be? Well, it's simple. If you look at this chart, here's a 1-year chart. The S&P is still an uptrend. These corrections, at least in this 1-year chart, have been buying opportunities. Now it's slipped below the 200-day moving average. Has that been a problem? Well, let's go back here and see if it's been an issue. Well, this is since the bottom going back in March, it's hasn't slipped below, well, just briefly. So again, everything's telling you that perhaps this is a potential buying opportunity. Again, not suggesting you do that, but that is what the charts are going to see. All right, so let's go on to high yield bonds, because high yield bonds are a good leading indicator for the broad equity market. And let's take a look at HYG. It went all bearish last week, so it's all red, still all red. And let's take a look at the chart, because it's telling you to watch this, because if HYG breaks down here, then you start to rethink your long positions in the broad equity market. Now you see the 6-month volume profile on HYG is well above, so sellers have been dominating this down to this purple line that I've got at 85.44. Let's zoom out to the 1-year chart, and what do you see? 1 year, the sellers have been dominant up here. And of course, think about who's issuing a lot of this junk bonds. It's corporations just taking advantage of the credit markets and the fact that investors are overly eager to buy it. Now it's come down to this 85.44 before. It's found support once, found support twice, found support 3 times. So it's giving you some indicator there could be a bounce coming. But look back now, if we go to the 2-year chart, this is kind of a make it or break it point for HYG. So if you see HYG start to break down here and get into the 84, maybe a mid 84 or even worse down to the 84, well, look for the broad equity market to go with it, because when you overlay the S&P 500 here, and you should look at these relationships when you have a chance. And so let's overlay the S&P 500. Let's zoom into the 6-month chart, and you can see a bit of a relationship there. Now it's not tight, and I wouldn't expect it to be, but you can see that as HYG goes down, the S&P 500 tends to do that. Let's go back to the 1-year chart, and you'll notice the HYG is mostly sideways here, but let's go to the 2-year, and you can see kind of a very similar relationship. Junk bonds led the broad equity market jumping up, and now they're trying to tell you it's rolling over and leading it lower. So keep an eye out on junk bonds as you watch the S&P 500. Look to grab support, hopefully early, to hold the market together. I'm Steve Van Metre. Thanks for watching. We'll see you soon here back for the NASDAQ 100 and Bitcoin charts. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or advice. Shares not to be construed as recognition or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Funds Advisors Inc. or Steven Van Metre Financial.